Okay, I record this video on Sunday, the 19th of August, 2018. So I'm going to start this video with my usual refrain. I have not put anything up on the website for quite some time, and I do apologize. I've been very busy. And I'm doing it to you again. I really do apologize again for it. Something has been happening in the background to do with the Emini-Watch website that hopefully I can talk about in the next 2 or 3 weeks once it gets kind of out there and resolved. But in the meantime, it has been taking my efforts and my energy, and yeah, that's all I can say. I'm also, and I hate doing this to you, I'm going to tease you with another thing, which is we're about to release a latest, greatest kind of version of the MTF indicators, hopefully in the next 2 or 3 weeks, that have got a new system, new kind of simplified view, and I think it's a really improvement on the indicators. So there you go, kind of 2 teasers that I can't really kind of discuss in very much detail until, you know, more kind of becomes clear in the future. So again, apologies. So, but let's talk about something kind of useful, potentially interesting to you, which is kind of the rotation indicators. I love talking about these because I love kind of the big picture. And it's prompted by a very nice email I got from Caleb a couple of days ago. So Caleb wrote, "Barry, as always, love the site. Thank you so much. I was wondering if you could do a video about what you're watching right now on the better rotation indicator, asset class and Forex." Yes, yes, yes. Also, more discussion about how you plan your longer-term currency and asset class trades would be much appreciated. Looking at cycling my capital in a similar fashion, would love to hear more about your thought process. I don't think it's anything kind of too fancy. On the asset side of things, what I try and do is hold 1 or 2 ETFs for the medium term that are kind of hot at the moment, and I use the rotation indicator to kind of track down what that ETF is. I tend to be doing it on doubles and triples, kind of the leveraged, highly leveraged ETFs, which is not recommended. You know, the people who build these ETFs say they are strictly speaking for day trading those assets, the doubles and the triples. So I'm doing something that's kind of pretty out there, risky maybe, and I get plenty of emails by people saying you should not be doing this and should not be recommending it. So I don't know, but that is what I do. On the FX side of things with Interactive Brokers, I keep my currency in the I keep my capital in the strongest currency at the time. And in the last few years, all that has been a function of is rotating between the Aussie dollar and the US dollar. Kind of move when, you know, the Aussie dollar is, or when the US dollar is weak, move my capital into Aussie dollar because that's a currency for me I'm super familiar with. And then when, you know, the US dollar is strong, swapping my base currency into US dollars. So it helps a little bit in kind of the overall kind of portfolio, but you know, more of it kind of comes in terms of those longer term gains from the ETF, if I get the ETF kind of right. So I'm going to talk about what I'm seeing at the moment, but I'm also going to revisit a couple of the trades that we've had over the last 2 years, really, on the ETF side, because they've done rather nicely. So this is the rotation indicator, which is available on the website for free. I've done a couple of different versions of this. One is for Forex and one is for assets. And I've also done a couple of others that I'll show you kind of later on in this video. But they have ETFs for each of the Forex pairs. Here, let me just show you this. So these are the symbols that we have. Actually, on these, I'm using the cash versus USD basis, and you can download this indicator. Certainly for TradeStation, it's available. Some of these need to be flipped around because they're Euro versus USD or USD versus Canadian dollar, for example, here. So we've got the Euro, the Aussie, the Pound, New Zealand dollar, Canadian dollar, Japanese yen, Swiss franc, Mexican peso, South African rand. These ones, you know, the South African rand, the Mexican peso, Canadian dollar, kind of more thinly traded, but they show you what's going on with the emerging markets, which right now is a super kind of hot topic with Turkey blowing up and so on. So on the first chart here, you can see the relative strength. I look back 52 weeks, calculate the percentage change in those Forex pairs. And then the white line is the average of all of those, because what that shows me is what those currencies are doing versus the US dollar. So, looking back over the last couple of years, since 2017, beginning of 2017, you can see all of those pairs were strengthening. The white line, thick white line, is going up until they started to weaken at the beginning of 2018 when the US dollar started to take off. So during 2017, we basically had a risk-on environment where the capital was moving out of the US dollar into more risky assets kind of around the world. And subsequently, that mood has changed. We're now on a risk-off environment since the beginning of the year, where they're moving out of risky assets and back to US dollar. So that's what that white line kind of shows you there. Then within those pairs, versus the US dollar, it shows you which of those currencies are strongest at the moment on a 0 to 100 basis. So you can see back in 2017, we had here the Rand was the strongest currency. Let me just show you that. There we go. So Rand is this olive green kind of color here. The Rand was the strongest currency, and then we had a series. We had the pound was doing extremely well. The peso was doing extremely well. The loonie was doing extremely well towards the end of 2018. And then the euro was doing well here for a good period of time. And then subsequently, as the US dollar, these currencies have weakened, the US dollar has been the play to be made. When I was looking at this today, I was interested because so much of the news out of the UK with Brexit is so bad. I couldn't believe the pound versus all of those other currencies has actually been doing the best performing of the lot. The weakest are the real emerging economies, so like the Rand, the Kiwi, the Aussie, the peso, doing extremely poorly. I mean, you could put the Turkish lira on here, you could put the Russian ruble on here. We've got a couple of other kind of lot smaller currencies, and the only reason I've not added them in is that we don't have a lot of back history on those as kind of currency pairs, and it shortens out this indicator because we got years and years going back to 2002 here with history kind of going on. So I rather like having that lots of history rather than including all of the currencies. But anyway, so let me just show you. So during 2017, the play was the euro, because that was the euro strengthening here with this blue line up here. And this is what the system view of the euro during 2017 was. System view of the better indicators, strength is shown with red bars, weakness is shown with white bars. We've got the 3 different time frames with support and resistance on here. The little lines are the lowest time frame, the thick lines are the highest time frame, and then we're looking for momentum plays. So exhaustion momentum, downside volume here with blue bars, and then bullish divergence comes in, that bottoms us. We have to go through some machinations with cycles ending, end of trend signals, bang, 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 and then we turn into strength with red bars showing a flush pattern here, and that's the strength that we got kind of after the first quarter in 2017 to the end of the first quarter of 2018, and we maxed out with exhaustion buying, bearish divergence, end of trend signals kind of come in here, one in the intermediate, one on the lowest time frame, bang, and that was the trade to be had. So during that 1 year period, the thing to hold was the euro, to have your currency in the euro or not the USD. So I was in the Aussie dollar during this period. And then subsequently, as the euro has weakened, so we've got our exhaustion, bearish divergence come in, we start dropping through significant supports here. We get into a downtrend, white bars, bang, 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 on the way down. And we are not over until we see exhaustion selling to mirror this exhaustion buying here. So we need to see more of these and bullish divergence. So we're in a downtrend in the euro, kind of continuing down. So almost a reverse kind of picture for the dollar index. Beginning of 2017, dollar index maxed out, exhaustion buy, bearish divergence, end of trend signals, and the strength there ends. We start to break into a downtrend with white bars breaking through supports, bang, 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 and we end up, January 2018, bottoming out on the dollar index. Exhaustion sell, bullish divergence comes in. We go through a couple of little end of trends and cyclical patterns here, and then we start breaking resistances into uptrends and got strength here. So one of the things to note, and I talked about this in the last video with the importance of trading with better momentum and how to read the patterns here. This is a exhaustion buying, getting the move going, because it's in the middle of the channel. If you have exhaustion buying like this, that shows that's people having to reverse out of positions, short covering rallies, getting this move going. moves end when we're outside of the channel and get those exhaustion patterns here. Add an extreme, add an extreme, add an extreme. That's ending things. This is more like getting things going. So although we fussed around a little bit with this end of trend and resistance on the highest time frame here at 94, 95s, we were just getting ready for the next launch up. And this thing won't be over until we see more exhaustion patterns, but at a more likely extreme level. So look for this to, I think we're going to go 100 and more, and let's see where this kind of goes. But for me, that is not exhaustion to end a move and start to reverse and go the other way. That's more likely in the middle of the channel, getting the thing going, getting ready to launch out the other side of the channel. So let's wait and see, but that's how I read it at the moment. So there we go. That was the rotation indicator showing you the strength that we had in the euro that you should have been part of during that 2017 into 2018. And then as all those currencies started to weaken here, should have been getting into the USD down at the bottom here as we kind of took off, and all of this this year we should have been in the dollar and still riding it on to see where this thing's going. So if that's the rotation indicator on the Forex pairs, what is it on the assets? And here we go. And I've done myself a little different version than the ones on the website at the moment, because I added in a couple more asset classes that I wanted to look at. But let me just show you what's on this one. So if we look at the symbols, so SPY is the S&P 500 ETF. EEM is the emerging market ETF. So we can look at the US equities and then the more high risk, kind of high beta kind of equities with emerging markets. TLT is bond market, and that's treasuries, US treasuries, long term, 20 and 30 year. And then LQD, which is the liquid bonds, so that's kind of corporate high quality stuff. HYG is bonds, but this is kind of the low quality junk bond stuff. So we got the three views of the bond market, if you like. DBA is agricultural futures, so this is all the stuff that's been doing really terribly kind of over the last few years, but you know, corn, cotton, soybeans, soy meal, you name it, they're all in DBA. Gold, GLD for the precious metal sector, which is gold, silver, platinum. IYR, which is real estate. Again, I'm going to talk about that later on in a chart, but that's another obviously huge asset class. That happens to be US real estate, and it's basically the REITs that are traded in the US. So it's not based on residential property in the US or worldwide or whatever, but it's a view of real estate, which is important to have as a huge asset class. USO, which is oil. So that's the energy kind of complex, not just oil, but gas and so on. And then DBB, which is base metals, and that's aluminium and copper. I think the big ones there. I think this is the one that I've added in lately that I wanted to have. I wanted to split the kind of futures contracts into a little bit more on the commodity side, so that we've got a view of the agriculturals, the metals, the precious metals, and then the energy complex, and all of those four on that side. It can get represented here. So again, this is the view percentage change over 52 weeks for the indicator, showing what's going on, what's kind of strong and weak, and then looking at that on a 0 to 100 kind of basis, so we can see who are the winners and who are the losers. And again, it's a similar picture to kind of risk on, risk off. So during 2017, the things that were doing well. So this is this purple line here is industrial metals. So that's copper that was doing extremely well. We've also got this grey line here. That's emerging markets. So they were doing well, the strongest at the beginning of the year and the end of the year there of 2017. And what else is kind of come good? Of course, crude. So crude having been tricky to play because we had a couple of false starts. The bottom in crude took almost 2 years to kind of make, and then it's obviously kind of taken off in the last year. I'd missed the takeoff in crude, but I'm in natural gas instead. because I'm hoping that'll have the same kind of pickup, and the move in natural gas has not taken place yet, whereas the move in crude oil has kind of taken place. And then down here during this 2018 period, you can see the things that have done really poorly is risk off. So we've got industrial metals; they went from being the strongest to the weakest, kind of down here. We've got junk bonds, we've got government bonds down here. Real estate has started to take off, and I think the bond market is about to take off. And here's equities. Equities been doing quite nicely kind of lately, but who knows whether we're going to kind of bust to new highs or whatever. But at the moment, I think there are better opportunities from looking at some of these plays kind of down here that may be starting to take off. But before I get to a couple of those charts, just to show you, this whole rotation stuff you can use in a couple of different ways. So here, this is looking at different equities markets around the world, and it didn't make a lot of sense for me to do this on a 0 to 100 basis for these equities markets, because some of these moves, the differentials are absolutely massive, between some of these emerging markets like Korea, for example, and Brazil. Brazil back in 2016 was off the chart in terms of the percentage moves, and so that would have just been up at the 100 line and everything else is down at the 0. So for me, it just made more sense to look at this this view of the world rather than the 0 to 100 kind of view of the world. But you can see during 2017, the equities markets that were doing the best. We had obviously Brazil kind of early on in that picture. We had Korea that was doing extremely well. Taiwan was also doing extremely well. China was doing extremely well. There's China with this little peak in grey line here. And as all of those emerging markets have kind of fallen off, look what is everybody's kind of rushed into the US market. So risk off has come into the US dollar and the US equities market. I think the US bond market as well. So I'll talk about that in a second. So you can look at the indicator like that. Let me switch that one off. Then you can also look at it in terms of sectors. So within the US equities market, you can look at all the different sectors, and you can see here's technology. It's been leading the way for 2.5 years, top of the peak, the pile for the red lines there for that whole entire period. We've got discretionary consumer stuff kind of coming up, doing quite strongly here. Discretionary is things like cars and refrigerators and big ticket kind of more discretionary items. Things like vacations, I think, are in there. The things that have been doing poorly, utilities, staples, and so on, kind of down here at the bottom. But again, the point of showing you this is the rotation indicator. You can see, as it changes between different sectors, moving from one being strong to weak and so on. Again, shut that one up. And then, here's another one. So I did this the other day because I was curious as to TradeStation actually now has some crypto kind of stuff on. So you can look at these format symbols, Bitcoin versus USD, Bitcoin Cash versus USD, Ethereum and Litecoin all versus the USD. Back history that we've got is kind of minimal, so this is actually a 240-minute chart. But again, you can do exactly the same thing. Look at the strength and weakness in those relatively. And what you see is when the market's kind of taking off, it's quite like the equities market, is that things go into like the Russell and the NASDAQ, the high beta type stuff. And that's the equivalent here is Bitcoin Cash, which is that green line there, and Ethereum, which is the red line. So they were doing quite well early on this year relative to Bitcoin. But then as the market starts to really weaken, the things that are doing best are things like, the equivalent in the equities market would be the Dow. The Dow 30 is safe and secure, and you know what's kind of going on. And the equivalent market in cryptocurrencies is obviously Bitcoin. So Bitcoin in the last 2 or 3 months has been the strongest of that grouping kind of going on there. But still, again, whether we're bottoming in, and I'm hoping we are bottoming in the cryptocurrencies around 6,500 for Bitcoin. And that'll lead the charge. The strongest move out of a downtrend, exhaustion move will be into the safe plays, the more traditional plays, the things that are strongest. So the Dow equivalent, and then as the move becomes more risk on, it moves into the more esoteric things. So that'll be more into the Ethereums and then Bitcoin Cash and other bits and pieces kind of around there. So there's a similarity to the way risk is perceived within the cryptocurrency versus the equities market. So let's shut that one off as well. Anyway, so going back to the rotation. So in the last year and a half, we've seen some nice plays. Here's the whole emerging markets kind of play that we've had over the last 2.5 years. So since 2016, this was EEM is emerging market ETF that kind of is a broad spectrum of all of the emerging markets, heavily weighted towards China. So again, the same system view, emerging markets, we bottom out, exhaustion, sell, bullish divergence, end of trends, and we start to base and find some strength. That exhaustion buying, short covering rally, it's also kind of getting the move going. And we spent some time basing here during the latter half of 2016, and then the move really took off. From the beginning of 2017, bang, this thing just almost went up 80% or so, doubling from the bottoms kind of down here. But here we go, red bars, strength, 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 all the way into exhaustion buy, bearish divergence, end of trends kind of going on here. And then subsequently, since the beginning of this year, it's all been about risk off, and the emerging markets has not been the place to be, and that's really kind of declined quite rapidly. Some of the nice plays in there. This is Russia. I was always going on about Russia. Russia was a nice play because it was partly emerging market and partly an oil play as well. So as we had strength in the ruble and crude oil and the Russian equity market, this was a really nice ETF to play. It was pretty jumpy kind of through here. But this is when I started talking about it and got into it. Got out too early. I was out in this region here, and it had a second run up into this kind of 24 region. But I'd swapped out of my Russia play into China, into MCHI. And this was really nice at the beginning of 2017. Again, I was talking about MCHI and into this run. Again, got out way too early into this. I was out in this region here, and it went to over 75s with an exhaustion kind of play here. But subsequently, here's we've got the exhaustion buy, bearish divergence, end of trend signals going off, and all this weakness starting. That exhaustion sell is getting the move going, and we've had another one here. Again, I don't think this is bottoming the thing because it's not in the right place for bottoming. We need to see it more at the bottom of a channel, kind of down here. So I think we're still going to see weakness in MCHI. And so one of the opportunities, if you want to be shorting the emerging market space with an ETF, one of the ones that's pretty big and interesting is Yang. So this is a triple short, triple bear on the Chinese market. I started talking about this back here middle of June when we were back at, I don't know, what was that there? Yeah, we were kind of 50 odd. We're at 64 at the moment. I'm not convinced about this yet because we've had quite a lot of blue professional bars at these highs. We might have to take some more plays to the downside on Yang to properly bottom this out. So I've not actually got into this yet, having recommended kind of back here. I'm still waiting and seeing how this kind of plays out. I need a little bit more kind of confirmation in my mind on this one. So that's the emerging equities story on the upside and the downside. And again, going back to this chart, the emerging markets was this gray line here. So emerging markets is the gray 34.59 there. So it was the strongest play during 2017, a couple of different places, and now it's come all the way down here to I think around 16 or so, so it's one of the weakest going on. So you could have ridden it on the way up with things like RSX and MCHI, and ridden it on the way down, potentially with Yang taking off, so kind of looking at that. Another similar one that kind of topped and has reversed was copper. And copper was a huge deal. This move in copper was massive. So we bottomed here in 2016, exhaustion, sell, bullish divergence. Then the red bars start to show. We go through some cyclical activity until we find a base here, and then bang, it launches out here, getting the move going and then ending the move here. Exhaustion buy, bearish divergence. Look at all these end of trends. Perfect. Lowest time frame, intermediate time frame, highest time frame, all coming together with exhaustion and bearish divergence, and then we start to break into a downtrend and really nice, nasty kind of move. Again, exhaustion selling, showing the strength of that move, getting the thing going. That's not bottoming it, not in my mind. So this is kind of getting going, ready to look at, back here. But that was, again, two stories on MCHI, on HG, which is copper. And so copper is industrial metals here, and it was this purple line, and it went from being the strongest to the weakest, kind of down here. Gold, here was another nice one. So this is the video I did a while ago when Mr. Jeff Gundlach, huge respects for him, but he said he thought gold was going up, and I said I didn't think so. Chart didn't agree, and this was inverse of gold, triple inverse of gold, DGLD, and that we were recommending that at 40. And look at it now, it's got up to kind of 60. No end of trend's gone off yet. Exhaustion buys into there, not bearish divergence kind of gone on. So I think it's still got some way to travel, but that was the entry kind of back here. Not at this point in time. You think you'd be looking for other opportunities rather than jumping on board that one. But that was another good one. So let's talk about what I'm looking at the moment, and it's bonds. Because of this. So this is TLT. This is an ETF that covers the 20 and 30-year bonds. And bonds are usually pretty damn uninteresting. And so the only way to play this is with a nice kind of triple long. So, but this is why I'm interested in it. So we've had this move. Didn't end up at the top here with exhaustion by bearish divergence. Sometimes the better indicator. We don't get the right read for that, but it definitely kind of reversed. We bottomed here, exhaustion, sell, bullish divergence, bang. Topped out here, exhaustion, buy, bearish divergence, bang. So this weakness now, we've had exhaustion, sell, bullish divergence. It's at an area, this 115 that we've seen over the last 2 or 3 years. That's pretty significant. So we've had exhaustion, sell, bullish divergence, a couple of flush patterns. The first blush of a little bit of strength here with red bars. Had the weakness, and we've got a triple support kind of coming in here, and this thing is looking like it's just indecisive at the moment. Obviously a break above this kind of area would be absolutely kind of critical, and that would show that we've busted out of here. Bond market going up means interest rates going down. One of the ways to play this, and this is the chart I'm looking at as well as TLT, but TMF is the way I'll play this once I get what I need. Similar looking chart to the TLT chart, but you can see here what we've done is exhaustion, sell, bullish divergence, end of trend goes off on the low, intermediate time frame, cyclical support on the highest time frame. There's our strength kind of coming in. We now have another little push down, and it's showing a little bit of weakness here. It's not quite ready to go, but cyclical resistance will be coming in at some point. It's a triple support at the moment, which is good, and that's holding. And we're getting up to the 19s. I put out a tweet the other day saying 1950 was kind of the number I was kind of looking at. But we need to see a nice, 1950 would be right because, as soon as it gets through this number 20, here, the moves we're going to get going pretty fast. So if it gets through 20, it's going to take off quick. So I want to be in there a little bit before, but it's not, kind of shown that get up and go kind of, launching on top of it yet. And I don't know, maybe what we need for the bond market to take off is a really nasty day in the equities market, and everybody's say, the equities market is temporarily kind of topped out as we're testing the highs that we saw January, February. So that is what I'm looking at now. Can you see it on the rotation indicator? Yep, you can. So here it is kind of down here. We've got the government bond market kind of sitting here. It's been doing pretty, nothing for a good long while, last kind of year, and that's what you need. You need the market to bottom out, get rid of all the sellers. So on the downside, it's kind of been sitting at the bottom of the pack for a while, and so kind of timing is right as capital rotates in and out of different asset classes, and I think it's kind of ripe to rotate into bonds. The one that's moved kind of before that is real estate, which again is interest rate sensitive, and IYR is the ETF to look at there. And you can see how that in the last, Why is that looking a little odd? Let me just hold on. There we go, it's a little better. Like this a little further away from the lines here. So exhaustion, sell, bullish divergence, cyclical support kind of comes in. We break into an uptrend. IYR is pretty uninteresting in terms of the size of the moves. You can see, you know, it's never a big kind of mover, and it's a REIT based ETF, so people are buying into it for dividend returns more than capital gains. But it's interesting that it's an interest rate sensitive sector, and that has been really quite strong over the last 2 or 3 months, that we've broken nicely into an uptrend. It has to get kind of above this kind of area, obviously, to get really interesting, but that's moved earlier than the bond market, but still interest rate sensitive, and so that's doing kind of quite well. So I like TMF as a bond market kind of play. IYR has started the move kind of earlier, but percentage moves are not interesting to me there on that. But then let me go back to the rotation chart, the one that at some point has to start to take off, and it's been absolutely slammed for the last 2 years, is this agricultural commodities, this blue line down here, and you can see, you know, it's been a loser for most of 2017 and 18, and it just keeps on getting slammed and slammed and slammed. So DBA is the ETF to check there, and you can see this thing has just been horrible, absolutely horrible. So and you know, we started to find some support around here. Exhaustion, sell, bullish divergence kind of comes in, and then, you know, that's not a short covering, or maybe it is a bit of short covering rally, but it just gave up the ghost at 19 and dropped again through 17. So all of those agricultural commodities are way oversold. At some point they will start to kind of turn. Maybe during 2019 that'll be the play, and everybody will start to talk about you know, kind of agricultural, what wheat and corn and soy meal and soybean, and yes, here's coffee. Look at this thing. It just keeps on getting weaker and weaker and weaker. And if I show you that on a weekly chart, yeah, there we go. Look, it was $400, yeah, back 6-7 years ago, and it's down $100. At some point, someone's got to say it's a steal down here, yeah, kind of copper. But anyway, so it's still in a downtrend on the weekly chart, on the daily chart, and so on. So at some point, all of those agricultural commodities will start to look interesting, and they'll start to kind of perk up. But as yet, they're the weakest of the play, and we might have to wait till 2019 before we kind of get into those. But anyway, so Caleb, that's what I'm looking at the moment. The two areas that I'm kind of interested in is staying long USD and looking at getting into TMF as a triple long bond kind of play. And for me, it'd be interesting, does that actually coincide with a bit of a top in the equities market and we get a flip side? Because all of the equities side on the emerging markets, everybody's saying to hell with that, you know, with all the news coming out of Turkey and so on. Not interested in any of those high beta kind of emerging markets. They're all going to get slammed with the same kind of psychological baggage. And then, you know, does that roll into the US equities market as well, as tech finally kind of gives up and people start saying, you know, it's about time to take profits on Apple and Facebook, etc. Anyway, so there we go. Apologies for the long video. And I'm not going to be able to get this out for a couple of days because the internet connection that I have right here, we're traveling at the moment, is just the worst I've had in 10 years. 1.2 megabits per second. Can you believe? Australia's supposed to be a first world country. Shocking. Anyway, hope you're doing well, and good luck with your trading.